Risk and term structure. So there's different kind of risks. We talked about it last time a little bit already. For example, for the Greek government bonds, we figured out there's default risk. There's a chance that the people that wrote the bond and promised you to pay money in the future simply run away, or they're bankrupt and they can't repay, or they don't want to repay you. That is so-called default risk or credit risk. Now there are some bonds that are considered fairly default risk-free. So for example, the US government bonds are considered fairly risk-free in regards to default risk. German bonds are pretty much risk-free, and Australian treasury bonds as well. That doesn't mean that there is no risk at all, just default risk is very low. There's still interest rate risk, as we just saw beforehand. Now, because people don't like risk, there's usually a risk premium put on top. And the risk premium is basically the difference between a risk-free interest rate and the interest rate on a bond that is somewhat risky. So liquidity premium here we don't worry about that much yet. That's the reason why it's gray. Default risk rating. So there's rating agencies, Moody's, Standard & Poor's, and Fitch, and they're basically checking different companies, different governments, and give their personal opinion how risky these bonds are. Now, why do I emphasize personal opinion? For example, in the past, we had so-called subprime mortgage-backed securities, and they often had AAA rating, but they defaulted. There was lots of trouble. You might have heard of the global financial crisis. And some people tried to sue Moody's, Standard & Poor's, and Fitch because they said, listen, these guys told us these are AAA bonds. They are very safe. I bought them. Now they defaulted. I lost a lot of money. And the defense of Moody's and Standard & Poor's Fitch was simply freedom of speech. We can say whatever we want. We are covered by freedom of speech. It's just our personal opinion that they were AAA. Tough luck that they defaulted. So that was their defense, and they went through with that too. That's the reason why I emphasize opinion. So if you read something as AAA, it just means that Moody's, Standard & Poor's say it's AAA. It doesn't really mean it's risk-free. But it's by and large the best thing that we can do. Some examples, so the US government bonds, they've got AAA rating by Moody's and Fitch. However, S&P already downgraded them a few years back to the second best rating, with a little plus, meaning there's an upside to it too, so they don't see much worry. Australia has, by all three rating agencies, AAA, so Australia is doing very well. And just to give you a counterexample, the Greek government bonds by Moody's, CAA, Fitch, CC, and S&P B. So it's further down here, highly speculative. So there's a good chance that you don't get all your money back after 10, 20, 30 years or 5 years. That the Greek government says, nah, sorry, we just ran out, we can't fully repay you. And the same ratings is happening for companies as well. So companies issue bonds as well, and they get rated as well. Here we've got some ratings in Australia over time. So in this case, Australian companies, Australian bonds. So companies are issuing bonds too to get finance in. Blue is AA rated, green A rated, the pink one BBB. So just remember which one is the riskiest one, the B or the A. So B is very riskier, and that also explains why they have to pay a higher interest rate. Because if you have two companies, one is very safe and the other one is considered risky, and both want to borrow money from you. If you give money to the risky company, you want to get something in return for taking that risk. So they have to pay a higher interest rate, and they have to offer a higher yield on those bonds. And we can see that here too. Then there's something called the swap rate for the time being. Just imagine that one as a AAA bond. And what we can see here is there's a difference between these. So the AAA bond is paying much lower yields than the BBB, and the difference basically comes from the risk. And that's the reason why it's called a risk premium, or also a spread. Spread is the difference between two interest rates. And we can see here, interest rates often move in the same direction. So if the blue line moves up, the pink line moves up too. Blue line down, pink line moves down too. But the difference between them is not constant. Here the difference was very small, so very, very low risk premiums. If you're a BBB company, you almost got finance as cheap as a AAA A company. But then here in 2008, something happened and all of a sudden the spreads were much bigger. Look at this one here. So here it is almost the same interest rate. Over here, what might that be? A bit over 5%, while the risky company had to pay more 6.5%, 7%. So that's 1.5, 2% difference between the two. And that's due to the risk. So something happened there, and we can jump ahead a little bit. Basically what happened there is the global financial crisis, and people all of a sudden got very afraid. We talk about the global financial crisis much later, much more, but just that you see a bit of a link how important that is and how much of a splash that made in financial markets. So here we've got the plot of the spread compared to government yields. So basically compared to the Australian government bonds. And we can see here, in the past, these are in basis points. 100 basis points equals 1%. So in the past, even the risky companies only paid 1% more than the Australian government. So if the Australian government had to pay 5% interest to finance itself, a risky company had to pay 6% interest. But now something happened here. In 2008, all of a sudden people became very afraid, very risk averse, and now they demanded much higher risk premiums. This is roughly 5.5% more than the government, the risky company now has to pay. So people became very afraid. And you can imagine how much of a difference that makes for the companies too. That finance is all of a sudden much more expensive. Since then it came a bit down again, but nothing compared to the good old times here. Now this graph is not super important to me, but if you like to think in graphs, we can explain the spreads a little bit and the risk premiums with demand and supply. Now just imagine that you have in your portfolio some corporate bonds, let's say BBB corporate bonds, you were pretty happy with it yesterday, and some Australian government bonds, a certain mix. And now you read in the newspaper, financial markets are in huge upheaval, we might enter a recession, things become very risky. Which of the two bonds do you want to get rid of quick? The corporate BBB or the Australian government bond? So it's most of you. I would get rid of that one too. And that means if we all sell our corporate bonds, what's happening to the price of these corporate bonds? If everybody's selling it, the price goes down, the yield up. Now what do we do with all the cash that we're getting? Now we have spare cash. Do you want to just put it under your pillow or buy some other bonds with it? Buy the safe Australian government bonds, the AAA. Because we still believe, despite a recession, the Australian government will repay us. And then we get at least some interest. So if everybody buys now the Australian government bonds, their price goes up. That means their yield down. And then we see something funny happening. Instead of all the interest rates going in the same direction, we have some interest rates moving down and other interest rates still moving up. So the yield on corporate, you can't really see it that well in this graph, but here it's visible. So if the Australian government yield is going down, so the risk-free rate is getting lower and lower and lower, at the same time the corporate bond rate is going up, that means the spread is just exploding. And that's exactly what we see here. It's also called flight to quality. So people get rid of all the risky stuff and they're flying and running towards the safe things. And this graph here is telling the same story, just with demand and supply, if you like that better. If you don't like that graph that much, don't worry about it. If you understood my explanation, just as good. Good, a little bit your turn again. Let's check the link here and find which country has the highest and which country has the lowest risk premium currently. Yeah, the country I can hear over there, the African countries, we don't have a complete list in this one here. I would imagine too that there are some African countries that might have very, very high risk premiums. But taking from this list here, if you look at this, so this one is a premium. This is the premium in, take a guess, basis points or percentage? 177 basis points. So this means 1.77%. And looks currently, Mexico is the winner. 6.34% they have to pay more than, in this example, the German Bund. So the Mexican government has to pay 6.34% more in interest than the German government. Much more expensive for them. So let's see which one is the lowest. Japan minus 42, Switzerland minus 51. Now what does that mean? First translating it into percent, so this is minus 0.51%. What does that mean that it's negative? The trick here is to remember we're talking not about interest rates themselves, but we talk about spreads, purely the risk premium compared to Germany. So let's say, for example, if the German government has to pay 2% on their bonds, the Swiss government has to pay roughly 1.5 they would pay only. Because people believe that the Swiss are even safer than the Germans. Or for whatever reason, people are really keen to have the Swiss government bonds. Similar for Japan. Let's see, where's the US? Well, the US has to pay a little bit more than Germany. So, summary, what did we get out of today's class, hopefully? We have different kind of risks. Last week we talked about interest rate risk. Today we talked about default risk. If you want to see how much default risk is in a bond, we can look at rating agencies. They might give only their personal opinions. They might be wrong, but it's the best indication that we have. So we have these AAA ratings, AA ratings, B and C ratings. And the more default risk there is, meaning the lower the likelihood that we're getting our money back, the higher should be the yield that we're expecting from them, because we want to get paid for risk that we take on board.